March 16th, 2020. The markets have been falling for 2 weeks straight. Your phone keeps showing you a number that gets worse every time you look at it. And somewhere between the second cup of coffee and the third time you open the brokerage app, a thought forms that feels less like a choice and more like a reflex. I need to make this stop. You have $43,000 in your 401k. Last month it was $57,000. Now it is $38,000, and the news is saying it could go lower. The feeling is not about money in the abstract. It is specific and physical. The way your stomach tightens when you see the number change, and so you do what feels logical in the moment. You move it to cash. You stop the bleeding. You protect what is left. Here is what happened next. The S&P 500 reached its crisis bottom on March 23, 2020, 1 week after you moved to cash. Then it started recovering, slowly at first, then faster. By August 2020, the index had fully recovered from all of its COVID losses. By the end of the year, it was at all-time highs. That $38,000 you moved to cash. If you had left it, it would have been worth over $64,000 by the end of the year. Instead, it was still $38,000, sitting in a money market fund earning less than 1%, while you waited for the right moment to get back in. A moment that kept feeling dangerous, no matter when it arrived. That scenario is not an exception. It is documented on an industrial scale. The Dalbar quantitative analysis of investor behavior is a study that has tracked the actual returns of millions of real investors for 30 consecutive years. It compares what the market delivered against what those investors actually received. The findings are consistent year after year. The average equity investor earns roughly 3 to 4% per year. The S&P 500, over the same periods, delivers approximately 10% annually. That 6 percentage point gap does not exist because most investors picked bad stocks. It exists because of 9 specific, repeatable behavioral mistakes. And almost all of them happen during financial crises. This video covers all 9. If this way of thinking about money, real data, real behavior, real cost resonates with you, subscribe to this channel. This is exactly the kind of thing they should have taught in school and never did. Let us make the Dalbar gap concrete, because a percentage difference sounds abstract until you run the math. Take $10,000. Invested at 4% annually for 30 years, it grows to approximately $32,000. The same $10,000 invested at 10% annually for 30 years grows to $174,000. The gap between those two outcomes, roughly $142,000, was not caused by investment choice. It was caused entirely by behavioral decisions, most of which were made during moments of crisis-driven fear. That is what the study measures, not what the market returns. What investors actually receive after all of their decisions, timed the way human beings actually time them under pressure. So where does that gap actually come from? Because most people assume that if you lose to the market, it must be because you made wrong bets. The Dalbar research says otherwise. The average investor in calm markets makes broadly reasonable decisions. They are not picking bad companies most of the time. They are buying index funds, staying the course, doing roughly the right things. The damage is concentrated in a few specific windows, the weeks and months surrounding major market crises. It is not a steady erosion. It is a series of sharp behavioral mistakes, each one triggered by fear, each made at the exact moment when the cost of the mistake is highest. A crisis does not create new bad instincts. It reveals the ones that were always there. Think about it like this. In a normal year, when the market is steady or gently rising, even an anxious investor tends to hold their positions. They might check the app too often, they might talk about diversifying, but not act on it. But they do not generally make catastrophic moves. The catastrophic moves come during the crisis window, the 30, 60, 90 days when prices are falling sharply. The news is full of worst-case language, and every conversation around you sounds like the same alarm. That specific window, when the cost of a behavioral mistake is highest because prices are lowest, is when the average investor consistently makes their worst decisions. The market recovers. The investor often does not, because they locked in the loss before the recovery started. Buffett has watched this cycle play out for more than 60 years. The quote he is most known for, "Be fearful when others are greedy and greedy when others are fearful," exists because he identified exactly this pattern. The average investor is most fearful at the exact bottom, when fear is most justified by recent events and least justified by forward-looking value, and they are most greedy at the exact top, when optimism is highest and risk is greatest. Buffett built his entire investment philosophy around being on the opposite side of that cycle. The answer is not a crystal ball. It is the understanding that the emotional clock and the financial opportunity clock run in opposite directions. And the person who holds steady during the fear window consistently ends up on the right side of history. Watch what Buffett actually did in the two biggest crises of the last 20 years. In September 2008, Lehman Brothers collapsed. The financial media was using words like systemic failure and depression. Most investors were reducing exposure as fast as they could. Buffett deployed $5 billion into Goldman Sachs and $3 billion into General Electric within 2 weeks of the collapse, on terms that only a cash-rich counterparty could offer, because the other side had no one else to call. In March 2020, when the S&P 500 was in freefall, Berkshire Hathaway held over $128 billion in cash and short-term treasury bills. Not because Buffett predicted COVID, because he is always positioned to act when others are positioned to retreat. That structure was built before the fear started. If you recognize the pattern we are describing, if you have made at least one of these moves in the past, write in the comments, "I see the mistakes." That acknowledgement is the first step. Mistake number 1, selling at the bottom. Here is what it looks like in practice. It is not a sudden decision. It is a slow accumulation of bad nights. You watch your portfolio fall 5%, then 10, then 20. Each morning feels like an update on how much you have lost. The news uses words like historic losses and market collapse. Your neighbor mentions they are getting out. Your coworker says they already sold. And then one morning, not dramatically, almost quietly, you log in and move everything to cash. Not because you made a financial analysis, because the pain of watching the number fall became greater than the fear of missing a recovery you do not yet believe is coming. The data on what happens next is precise and painful. In the weeks surrounding the COVID market bottom, the Investment Company Institute recorded some of the largest weekly outflows from equity mutual funds and ETFs in market history. Hundreds of billions pulled out of stocks in a concentrated window of maximum fear. The S&P 500 hit its exact lowest point on March 23, 2020. The average investor who sold in that window did not experience a paper loss. They converted it into a permanent one. A portfolio worth $50,000 on January 1, 2020 had dropped to about $33,000 by March 23rd. If you held, it was worth over $68,000 by year-end. If you sold at the bottom, you locked in $33,000 and still had to decide when to buy back in at higher prices. Buffett has a simple framework for this. A paper loss is not a loss. It is a number on a screen. It represents shares you still own. In an index fund, it represents small pieces of hundreds of companies that are still open, still producing, still employing people. The loss becomes real only when you sell, only when you convert the paper claim into cash. At that moment, and only at that moment you have both locked in the loss and removed yourself from the recovery. The asset that falls 40% and then doubles is essentially a wash for the investor who held throughout. The person who sold at the bottom, they locked in 40% down and paid a significantly higher price to get back in. Mistake number 2, going to cash at the wrong time. This one is trickier because it does not feel like a mistake. It feels like wisdom. There is an internal voice that says, I am not selling out of fear. I am being smart. I am protecting my assets. I will wait for the right moment to get back in. That voice sounds very different from the panicked seller who moves everything at the first sign of trouble. It sounds rational. It sounds like risk management. The problem is that waiting for the right moment during a crisis recovery is structurally identical to market timing. And the data on market timing is unambiguous about what it costs. JP Morgan Asset Management has tracked this finding across multiple market cycles. If you missed just the 10 best trading days in the S&P 500 over a 20-year period, your annual return dropped from approximately 9.8% to 5.6%. Missing 20 days cuts it to 2.7%. Missing the 40 best days produces a negative return. You actually lost money over a period when the market nearly doubled. And here is the detail that makes this painful. 7 of the 10 best trading days in any given crisis recovery window occur within 2 weeks of the 10 worst days. March 24, 2020, the single best trading day of that entire year, happened the day after the bottom. The person in cash, waiting for certainty, missed the most important day of the year by exactly 1 day. If this is opening up something you have never seen clearly before, let me know by liking this video. It helps more people find this at the right moment. Here is the outcome before the explanation, because this mistake is best understood backwards. The person who moved to cash in mid-February 2020 and held it through August watched the S&P 500 recover from its bottom and begin setting new all-time highs from the sidelines. Every day they stayed in cash felt like confirmation that they had made the right choice, right up until the market proved them wrong. Cash does not feel dangerous during a recovery, but in that context, it is the most reliably damaging position to hold because it requires you to make a second correct timing decision in order to recover from the first one. The first decision, when to exit, was wrong. The second decision, when to re-enter, is equally hard to get right. Most people do not. They buy back in after most of the recovery has already happened. Mistake number 3. Buying gold after it has already risen. You know this feeling. Gold is on every financial news channel. Your financially adjacent friend mentions it at dinner. The headlines say things like gold hits record high and investors flee to safety. And the thought forms, I should have some of this. There is a logic to it that is hard to argue with in the moment. Gold is real. It holds value. It does not go bankrupt. Everything the headlines say about it during a crisis is technically true. What the headlines do not explain is the timing. Specifically, that the moment gold becomes a household topic is almost always the moment the easy return in the trade is already gone. Gold's behavior during crises follows a consistent pattern. It rises sharply during the fear phase when uncertainty is highest and the flight to safety is at its peak. Then, as the crisis resolves and risk assets recover, gold plateaus or declines as capital flows back toward equities. The investors who made money on gold in 2020 were the people who held it going into 2020 at around $1,500 per ounce. By August 2020, gold hit an all-time high of $2,067 per ounce, but the investors who bought it in March or April 2020, responding to the headlines, paid $1,400 to $1,700 for an asset that peaked months later and then spent years trading below that level. And the investors who chased the 2011 peak at $1,900 per ounce watched it fall 45% over the following 4 years. Buffett has been consistent on this for 50 years. He draws a clear distinction between holding gold as a deliberate pre-crisis hedge and buying it because headlines told you to. Gold does not produce earnings. It does not pay dividends. It does not expand its operations. Its price is driven almost entirely by sentiment, how fearful people are at any given moment. That is not a property of a productive asset. The hedge version of gold, a small allocation, bought when markets are calm, as insurance against a decline you cannot predict, has real value in a portfolio. But buying gold after a crisis is already underway, when sentiment has already driven the price, is buying the insurance after the accident. The protection you were looking for had already been priced in by the people who prepared before the fear started. Mistake number 4. Increasing debt to cover living expenses during the crisis. Picture this. It is April 2020. You are 3 weeks into working from home or not working at all, and the grocery store feels more expensive, more anxious per trip. Maybe your income dropped. Maybe your hours were cut. The emergency fund, if you had one, is already in use. And so the credit card starts doing work it was not designed to do. Gas, groceries, the electric bill, the car insurance. The balance goes from $800 to $1,500 to $3,000, and the logic in the moment is completely sound. This is temporary. I will pay it off when things normalize. If you have been understanding the theory for a while, but the gap between knowing and actually building the structure still feels real, there is something in the first pinned comment that was put together specifically for people who are ready to close that gap. Check it when you're done here. Here is what temporary actually costs. The Federal Reserve's consumer credit data showed a significant spike in revolving credit balances in early 2020 as households absorbed income disruptions before relief programs arrived. If you added $5,000 in credit card debt at 24.7% APR during that window and made only minimum payments going forward, the total cost of that debt over the full repayment period exceeds $13,000. The crisis that created the debt lasted approximately 12 months for most households. The debt, paid on minimum terms, takes 27 years to eliminate. Every dollar of crisis debt is a future dollar that is not compounding in an asset. It is a future dollar being extracted by the lender, month after month, long after the crisis that created it is a distant memory. So what is the alternative? Buffett once said, "The time to repair the roof is when the sun is shining." He was not talking about literal roofing. He was describing the only structure that actually protects you in this scenario. A 6-month emergency fund, fully funded, held in a high-yield savings account or short-term treasury bills, never touched except for a genuine income disruption. The person with 6 months of expenses in reserve during a crisis does 3 things differently. They do not touch their investments, they do not go into high-interest debt, and their compound engine runs uninterrupted through the entire crisis window. They emerge from a 12-month crisis with their financial structure intact, the result of preparation work done during the preceding months of calm, not luck. Mistake number 5. Cutting investment contributions first when the budget gets tight. Have you ever sat down to review your budget during a financially stressful period and worked through the list? The car payment? You cannot skip that. The rent? Non-negotiable. The utilities, the groceries, the insurance. And then you get to the $400 monthly 401k contribution, and something about it feels different. You chose that number. You could choose a different one. Nothing bad happens immediately if you pause it. The 401k contribution has no emotional urgency attached to it. It does not send late notices. There is no collection call if you skip it. And so it becomes the first thing that goes. When the budget gets difficult, it feels like the safest cut. In reality, it is the most expensive one. Here is the outcome before the mechanism, because this mistake is most clearly understood in reverse. The investors who continued making 401k contributions during the October 2008 to March 2009 period, the absolute floor of the financial crisis, were purchasing S&P 500 shares at index levels roughly 60% below their 2007 peak. The shares purchased in that window compounded for the following 15 years. By 2022, the S&P 500 was trading at levels more than 5 times above that crisis low. The investors who paused contributions and resumed in 2010, 2011, or 2012 bought back into a market that was already 30, 40, 60% above the prices they had stopped buying at. They did not miss the market entirely. They missed the most important entry window of the decade because the contribution pause happened to coincide exactly with the period when buying would have mattered most. Look, if you genuinely need to reduce expenses during a financial crisis, the order you do it in determines the long-term cost. Entertainment spending is the first to cut. Dining and convenience spending is second. Subscriptions and non-essential recurring services come next. If the pressure is severe, consider reducing the investment contribution temporarily, but not eliminating it entirely. Even contributing half your normal amount during a crisis maintains dollar-cost averaging at crisis prices. The emergency fund is protected for genuine income disruptions, and the investment contribution is the last item you address, not the first. Most people reverse this order because the investment contribution has no immediate consequence and feels like the easiest thing to pause. But it is the cut with the highest compound cost over time, and it is being made during the exact window when its opportunity value is greatest. Mistake number 6, reacting to financial news in real time. CNBC on in the background, portfolio app open on your phone, down 7%, down 4% on Tuesday, down 11% this morning. Every analyst has a different prediction. One says the bottom has not come yet. Another says the recovery has already started. A third says this crisis is structurally different from any previous one. You are absorbing all of it, processing all of it, feeling the need to respond to each new piece of information as it arrives. This is the most seductive mistake on this list because it feels like staying informed. It feels like being responsible. It feels like the opposite of burying your head in the sand. It is not. Research on investor behavior consistently finds that frequency of portfolio checking is inversely correlated with actual returns. Investors who check their portfolios daily, particularly during periods of volatility, trade more frequently, generate more timing errors, and end up with significantly lower returns than investors who check monthly or quarterly. And the news cycle during a crisis is specifically engineered to produce checking behavior. Every negative data point gets amplified. Every analyst who predicts continued decline gets more airtime than the one who counsels patience. The information is designed to generate engagement, which means it is designed to generate anxiety. The daily news cycle about your portfolio is not financial information. It is noise that happens to be formatted to look like financial information. Buffett does not watch financial television. This is not a trivial piece of lifestyle trivia. It is the operating principle that separates his information environment from the average investors. He reads annual reports, financial statements, industry analyses, history books. His information diet is designed to answer one question: does the underlying business have more or less long-term value than the current price reflects? That is a signal question. Financial news answers a different question. What is everyone else feeling right now? That is a noise question. The practical result is that Buffett's decisions are driven by analysis of what a business is worth, while the average investor's decisions during a crisis are driven by the aggregated emotional state of every other market participant. filtered through media incentives designed to maximize clicks and eyeballs. Mistake number 7, market timing. And I do not mean elaborate chart-reading strategies. I mean the simple version, the thought that goes, I will wait until the bottom is in before I buy back in. Have you ever thought that? Of course you have. It is almost irresistible. Markets are falling. Why would you buy now when they might fall further? Why not wait for certainty? Why not wait for the news to stabilize before re-entering? The logic seems airtight. The problem is that the data on actually executing this strategy, on waiting for the bottom and then buying, is one of the clearest findings in behavioral finance. Almost nobody gets the timing right, and the cost of getting it wrong is not small. JP Morgan's data covers the S&P 500 from January 2002 through December 2022, a 20-year span that includes 2 major crashes and multiple significant corrections. Fully invested throughout that period, approximately 9.8% annually. Miss the 10 best trading days, 5.6%. Miss the 20 best days, 2.7%. Miss the 40 best days, a negative return. You lost money over a period where the market nearly doubled. And the detail that makes all of this genuinely painful, 7 of the 10 best trading days in that entire 20-year period occurred within 2 weeks of the 10 worst days. The recovery and the collapse are neighbors in time. The person waiting in cash for the fear to fully resolve before re-entering is waiting to miss the most important days of the cycle. Buffett's Coca-Cola position makes this concrete. He began buying in 1988. Since then, that investment has survived Black Monday, the savings and loan crisis, the dot-com collapse, September 11th, the 2008 financial crisis, the COVID crash, and multiple smaller corrections. At every single one of those crisis points, there was a reasonable-sounding argument for why selling made sense. Coca-Cola was overvalued, consumer spending was weakening, the market was going lower. He held. As of recent years, his original investment of approximately $1.3 billion generates over $700 million per year in dividends alone. The holding period was forever. The return was extraordinary precisely because he did not try to time any of it. Mistake number 8, following the crowd. Here is how this one enters your life. You are at a family dinner in October 2008. The financial crisis is the entire conversation. Your brother-in-law sold everything 3 weeks ago. Your co-worker says he is going to wait 2 years before getting back in the market. A friend who has never talked about investing before is telling you to buy gold. The consensus in the room is unmistakable. Things are getting worse. It would take a very deliberate mental effort to hold a position that nobody around you is holding, and it is not just social pressure. In that specific moment, the crowd is not obviously wrong. Things are genuinely bad. The case for getting out is louder and better articulated than the case for staying in. Here is the data on what the crowd actually signals during a crisis. The AAI Investor Sentiment Survey measures what percentage of individual investors are bullish or bearish on the market's 6-month outlook. At the March 2009 bottom, the exact lowest point of the financial crisis, bearish sentiment among individual investors was approximately 70%. 7 out of 10 individual investors expected the market to continue falling. It did not. It rose more than 400% over the following 12 years. At the COVID bottom in late March 2020, bearish sentiment again spiked to extreme levels right at the turning point. The crowd is not wrong because it is uninformed. It is wrong because it is reacting to the same information simultaneously, which means everyone inside it is making their behavioral mistake at the same moment, creating a signal that tracks almost perfectly with the actual opportunity in the opposite direction. And here is something most people miss. Charlie Munger, Buffett's partner of over 60 years, had a framework he called inversion. Instead of asking what you should do, Ask what the average person is going to do in this situation, then consider the opposite. Applied to a crisis, the average investor sells equities, moves to cash, buys a late-cycle hedge, cuts contributions, follows the news cycle, waits for certainty before re-entering, and follows the crowd's direction. Now, invert every one of those. Hold equities, maintain contributions, build the hedge before it is needed, ignore the noise, act on analysis, not sentiment. Every time you invert the average investor's crisis behavior, you end up with a description of what Buffett does. The inversion is not coincidence. It is the entire strategy. Mistake number 9. Deciding that this crisis is too unique for old wisdom to apply. You know this voice. It says, I understand all the historical arguments, but you have to admit this one is different. The specific combination of factors right now is genuinely unprecedented. Maybe it is a global pandemic. Maybe it is regional conflict affecting energy supply. Maybe it is a banking system stressed in ways it has never been before. The voice is specific. It has evidence. It can cite the exact ways this crisis differs from every previous one. And it is completely correct that the trigger is unique. What it consistently gets wrong is the conclusion it draws from that fact. Every major financial crisis in the last 100 years was declared unprecedented at the time. The Great Depression, World War II, the 1970s oil shocks, Black Monday in 1987 when the Dow fell 22% in a single session. The dot-com collapse, driven by a technology adoption curve that no historical model had ever priced. September 11th, the 2008 financial crisis, described accurately as the worst since the Depression. COVID. Each one was, in its specific cause, genuinely unique. The S&P 500 recovered to new all-time highs after every single one of them. The trigger was always different. The direction of the recovery was always the same. Buffett addressed the "this time is different" argument in multiple shareholder letters with characteristic directness. He noted that he has heard that argument made every decade, for every crisis, by intelligent people with real evidence. It has never been a reliable reason to abandon a long-term diversified position in productive American businesses. The U.S. economy has expanded through wars, pandemics, political upheaval, hyperinflation, and deflation for 2.5 centuries. The crises feel existential in the moment. The data on what followed says they were not. Changing your long-term strategy based on each crisis's specific narrative is how you guarantee an outcome that differs from the historical record, and not in the direction you were hoping for. Now here is what the full cost looks like when you add it up. The Dalbar study says the average investor earns roughly 3 to 4% per year instead of 10%. Take $50,000 invested over 30 years. At 4% annually, it grows to approximately $162,000. At 10% annually, it grows to approximately $872,000. The gap, roughly $710,000 on a $50,000 starting position, was not produced by bad investment choices. It was produced by 9 behavioral mistakes at crisis moments across an investing lifetime. Not one catastrophic decision. 9 repeatable, predictable patterns, each triggered by a crisis, each compounding over decades into an outcome that feels impossible until you understand the mechanism that produced it. And here is why these mistakes cluster around crises specifically, because that is the insight that changes how you use this information. In a normal market environment, the emotional cost of holding a diversified long-term position is low. The market is calm. Your portfolio is not the source of your anxiety. You can make rational decisions because your brain is not in survival mode. A crisis changes that equation immediately. It loads every financial decision with emotional weight that the human brain was not designed to handle calmly. Behavioral economics research consistently finds that the fear of loss is approximately twice as powerful as the pleasure of equivalent gain. During a crisis, that asymmetry is at its maximum, and that is precisely the moment when the correct decision, hold, continue contributions, ignore the noise, requires the most emotional discipline to execute. Honestly, look at all 9 mistakes together, and you notice something they share. Every single one is a reaction. Panic selling is a reaction to fear. Going to cash is a reaction to uncertainty. Buying gold after it rises is a reaction to headlines. Taking on debt is a reaction to a gap that a pre-positioned emergency fund would have absorbed. Cutting contributions is a reaction to short-term cash pressure. Following the news cycle is a reaction to information overload. Market timing is a reaction to the feeling that the bottom is not yet in. Following the crowd is a reaction to social pressure. This time is different is a reaction to the specific narrative of the current crisis. Not one of the 9 is a proactive decision. They are all triggered responses, and the structure that Buffett has built, the cash reserves, the productive holdings, the permanent holding period, is specifically designed so that none of those triggers requires a reaction. What Berkshire looked like entering 2008? Approximately $33 billion in cash and short-term securities. What Berkshire looked like entering 2020? Approximately $128 billion. Buffett did not build those positions because he predicted the exact crisis that followed. He built them because that level of liquidity is always the right structure. It earns a real return in normal times, and it becomes a deployment weapon when prices reach levels that justify it. He did not react to 2008 by accumulating cash. He was already positioned. He did not react to COVID by moving to safety. He was already there. The preparation was permanent. The crisis was temporary. And when the crisis arrived, he did not have to make any of the 9 reactive decisions, because the structure had been built before the fear started. Pay attention to this, because it matters for how you use this information. The 9 mistakes are not moral failures. They are not signs that you are bad with money or insufficiently disciplined. They are predictable outputs of a human brain operating under conditions it was not built to handle. The part of the brain that processes fear, the amygdala, does not have a separate mode for financial losses and physical danger. It treats a dropping portfolio with the same urgency as a physical threat. The response is designed to make you act fast to remove the source of the pain. That response saved your ancestors from real dangers. In a financial crisis, it consistently produces the worst possible financial decision at the worst possible moment. Knowing the names of these 9 mistakes, recognizing them as they form, is how you interrupt the reflex before it becomes an action. The next crisis will come. Nobody knows the date. Nobody knows the cause. It might be a banking event, a geopolitical shock, a technology disruption, a pandemic, a combination of factors nobody predicted. But here is what you do know now, because you just watched it documented 9 times in this video. The news will feel catastrophic. The numbers will feel personal. Everyone around you will have a strong opinion. The crowd will be moving in one direction. Your gut will have a very clear suggestion about what you should do with your money. And every single one of those feelings will be trying to trigger one of the 9 reactions this video just mapped out for you. You do not have to be the average investor. The Dalbar gap, that 6 percentage point annual difference between what the market delivers and what most people actually receive, is not random distribution. It is a behavioral tax, paid at crisis moments, that compounds over a lifetime into the single largest determinable factor in long-term investing outcomes. The person who understands these 9 patterns, who can name them when they feel them forming, and who holds steady through the crisis window, will not have a perfect investing record, but they will be on the right side of a 30-year outcome that separates the prepared from the reactive. The information is here. The rest belongs to the next crisis, and what you choose to do when it arrives. Stay curious, stay informed. If you stayed until the end, write in the comments, "I am not the average investor." There is another video on your screen right now. The next step in understanding how money really works. Thank you for watching. We will see you in the next one.